I think there's a chance that volatility is being built up, is being suppressed in Bitcoin. As I mentioned, will be released on the upside, meaning we could have a really fast move upwards at some point. The big question, if you're allocating for the next 10 years, is not whether the bottom is in Bitcoin, it's whether the top is in. And I think what Jan is saying is the top isn't in, right? We're printing deficits. The world is uncertain. Bitcoin is pretty certain. It's at this sort of natural cyclical low. Who cares if it goes down 10% or more? I think it's going to go up 5x.
There is a strange contradiction unfolding in crypto right now. Bitcoin can spend weeks going sideways, frustrating investors who were expecting another explosive move, while behind the scenes some of the biggest financial institutions on Earth are moving deeper into the technology at a remarkable pace. That creates a difficult decision for anyone looking at Bitcoin today. If you believe the long-term thesis is intact, should you put your capital to work now while prices are depressed, or keep waiting for the next leg lower? Should you try to catch the bottom with one large allocation, or spread your purchases out and accept that you might pay more later? In his latest interview, Matt Hougan argues for doing either, depending on your investment objectives. One approach is about maximizing potential returns. The other is about minimizing the risk that your own emotions cause you to miss the move entirely. But there is an even bigger question underneath that debate. What if investors are focusing too much on where Bitcoin trades over the next few months and not enough on where the financial system is heading over the next decade? Because while retail investors debate whether Bitcoin can fall another 10 or 20%, BlackRock and other financial giants are working toward a world where stocks, bonds, funds, and other assets can trade on blockchain rails around the clock and across borders. And if Hougan is right, this period of apparent market apathy could actually be one of the most important accumulation and infrastructure building phases the industry has seen. So in this video, we're going to examine Hougan's case for Bitcoin, the surprising resilience of the market despite a long list of negative catalysts, and why institutional adoption may matter far more than the short-term price chart. We'll also look at Standard Chartered's enormous projection for the tokenization economy and what it tells us about the scale of the transition now underway. If you find this analysis useful, hit the like button, subscribe to the channel, and turn on post notifications so you don't miss our next breakdown.
I was worried when I was writing the memo that everyone was expecting the final news on the Clarity Act by August 5th or August 7th because Congress was going into recess. And we had circled those dates on our calendar for months. We had talked about August. And what occurred to me is that that's not the way Washington works. As we sort of started to approach that, you heard this senator or that senator start to talk about maybe we could address it in September, or maybe we could do it in the lame duck session. So what I wanted to prepare people for was that the event we were going to finally have happen, this sort of deciding moment for clarity, was going to be a fizzle. And sure enough, that's actually what happened, right? It didn't get acted on before the August recess, but at the last minute, a senator filed for a potential vote in September. So we sort of have this dribble off into the distance. My expectation is that this thing will never die and maybe will never pass. It will just sort of live in this perpetual almost state. Now, I could be wrong about that. I think there's a chance that Congress comes around and agrees to pass it before the election if we put the right kind of political pressure. But the base case is we're still in this sort of waking undead moment for the Clarity Act until the end of the year. I do think the other part that I said, which also is coming true, is that crypto will move on without it. When I talked about that, I mostly focused on the idea that crypto will continue to build without it, right? Wall Street will move on tokenization. People will move on stablecoins. There's actually been another piece that has bubbled up over the last week or so, which the SEC is just going to do rules without the Clarity Act. If the Clarity Act won't pass, then the SEC will establish rules. And sure enough, that's what we've heard out of the SEC. We expect major rule making next week on tokenized stocks, on how new crypto projects can be born without triggering automatic SEC oversight, how they can decentralize. The SEC is just going to plow ahead. So I think it's a win for the crypto market. I think it would have been better if it passed, but it wasn't going to, and we ended up in a good place. Financial firms love making money. And they will make more money if stocks trade 24/7, 365 than if they trade from 9:30 to 4, 5 days a week and not on holidays. They'll make more money if stocks are available globally to an audience of 8 billion people than to the US and an audience of a couple 100 million people. So they want to do this. That's why you see all these tokenization projects. That's why you see all these firms talking about it on conference calls. The limiting factor has been regulatory. But if the SEC is going to establish rulemaking that provides a project to get us from here to tokenized trading, Wall Street is going to rush through those doors. The thing that always hits me when we talk about tokenization is that the market right now is so tiny. It's $300 billion of assets on chain. Tokenized stocks really are a few billion dollars. The global equity market's $110 trillion, right? So I think people miss the scale of what is going to happen. When you have regulatory progress and the opportunity for Wall Street to make money, you end up with rapid action. I just think that's what we're going to see. I think it's almost inevitable. We get a headline every day. I think it's going to be a mega trend for the next couple of years. I think there's some good analogies that we can point to. It looks like Uber. It looks like Airbnb. It looks like the early days of the internet. There have been plenty of examples where consumers and companies moved ahead of the current regulatory status quo because there was demand on the other side that was obvious, and they felt they could do it in a safe and successful manner. That's what we saw with Uber and Lyft. As I said, that's what we saw with Airbnb. Eventually, the regulation catches up to it. So why is BlackRock doing it? BlackRock's doing it because they feel they can do it in a compliant fashion, and they know there's demand on the other side of the spectrum, and they know the world is moving to tokenize all assets, and they want to be the world's largest asset manager in that world, just as they are in the current sort of paper certificate world. So they're plowing ahead. You're going to see this across the board. And it also builds on itself, because if BlackRock is doing it, then the board of every other asset manager is asking why they're not doing it, and they will follow in a few months. I do think it's basically an inevitability. Assets want to move 24/7, 365 on a global basis. The way to do that is on chain. We're going to see all assets move on chain over the next 5 to 10 years. And what we're seeing now is just sort of the early steps in that process.
Do you think that regulatory risk, or that, the anti-crypto army coming back to power in some way, is a risk that the market is still concerned about, or are they kind of looking through this at this point?
It's always a risk, because you never know if an extreme part of a political party can come back into power. But I think when it's not just crypto pushing this forward, when it's BlackRock and it's NASDAQ and it's NYSE and it's JP Morgan and it's Standard Chartered and it's other giants in the space, when they are behind it, I think it just gets very hard to put back into sort of the original bottle. Now, there are aspects, there are corners where there could be questions and challenges. And I think those corners can slow our growth, right? There are concerns around developer liability. I think there is uncertainty in that space. But the broad idea that we're moving assets on chain, I just think there's no way even the anti-crypto army will be able to peel that back. And I think they would be wrong to do so. That will be a better, more efficient world for more people. It'll be safer. I think we're going to end up there. So no, let them chatter. They're a dying breed. And I think they'll be sort of relegated to the dustbin of history in the next couple of years.
There is a reason Hougan keeps returning to tokenization. This isn't simply another crypto narrative built around speculation. It is an argument that the plumbing of global finance itself could be changing. Standard Chartered has projected that the value of tokenized assets could reach roughly $4 trillion by the end of 2028, compared with around $340 billion today. The bank's broader research argues that the expansion of tokenized real-world assets could dramatically increase demand for the blockchain infrastructure supporting lending, trading, settlement, and decentralized finance. And that brings us directly back to Bitcoin. Because if the financial system is gradually becoming more digital, more global, more programmable, and increasingly dependent on blockchain infrastructure, then Bitcoin doesn't have to dominate every transaction to benefit from the transformation. It simply has to remain the most established, liquid, and recognizable digital monetary asset, while the ecosystem around it expands.
Bear markets die in apathy, and you know that they're dead when the market stops reacting to bad news. And we've had a slew of bad news from the broader equity market volatility, right? The most significant momentum compression trade in history happened around situational awareness. And Bitcoin just sort of shrugged. You had sailors selling significant amounts of Bitcoin. Bitcoin really doesn't care. We had the Clarity Act odds fall from 40% to 14% over the handful of a few days. I think Bitcoin rallied. Bear markets die in apathy, and they're dead when they stop reacting to bad news. That's what's happening in Bitcoin. It's happening because anyone who was going to sell sold. And it's left in the hands of people who think this is going to be worth $1 million a coin. So they don't care if an AI bubble unravels a little bit. That will probably end up being good for Bitcoin. So I take a lot of comfort in its pancake sidewaysness. I do think volatility is being sort of stored up and will be released eventually. My expectation is it will be released on the upside, not the downside. That's not a guarantee that the bottom is in, but it does have the attributes of a real bottom. That's what we're seeing in the market today, and it's making me pretty excited. One of the biggest risks in crypto is behavioral risk. You invest, the market pulls back 15%, you panic and sell it, and you don't come back to it until you're at new all-time highs. The beauty of DCAing is it protects you from a behavioral sort of failure, right? If you buy 10% this month and then it goes down next month, you're excited to buy that next 10%. So it's like a behavioral hack, right? And then if it went up 10%, that's okay. At least you had some. It's a really nice behavioral mechanism for investors who may not be comfortable with Bitcoin's overall volatility. But from an absolute return perspective, I think Jan is exactly right. I think there's a chance that volatility is being built up, is being suppressed in Bitcoin. As I mentioned, will be released on the upside, meaning we could have a really fast move upwards at some point. The big question, if you're allocating for the next 10 years, is not whether the bottom is in Bitcoin, it's whether the top is in. And I think what Jan is saying is the top isn't in, right? We're printing deficits. The world is uncertain. Bitcoin is pretty certain. It's at this sort of natural cyclical low. Who cares if it goes down 10% or more? I think it's going to go up 5x. That's the argument to just buy it all now. So it really comes down to whether you're return maximizing or behavior risk minimizing. That's how I would split their two views. My view is just own it, come back to it in 10 years. I think you'll be very happy.
Do you have a view on this and this the growing consensus around October as a bottom for Bitcoin?
Yeah, I mean, it is consensus. I mean, you literally hear it 3 or 4 times a day from 3 or 4 different people. And that does make me nervous. The calendar has been a reliable indicator of Bitcoin returns, much more reliable than I anticipated over the last couple of years. So who am I to say that it won't continue to be reliable? Again, I would go back to that point I made about what Jan was saying, which is, yeah, maybe it goes down a little bit. The consensus is we could trade into the 50s. But if you think this is going to $1 million, do you really want to take that risk? So I know the honest answer is I don't know. I think we're higher by the end of the year. The path between here and there depends on a lot of different factors, but I think the upside is much more significant than the downside at this point. And to peel back, do you care if you bought at $5,000 in 2018 or $3,500 in 2019? We're at $63,000 now. In either case, you did pretty well. I think that may be the scenario that we're in. The number one surprise for me over the last month, I've been spending a lot of time with the largest wealth management platforms in the world, right? Whether it's a Wells Fargo or the UBSs or the Stifels, et cetera. The most surprising thing to me about those conversations is just this recognition that those ships have turned slowly towards crypto, and they really don't care about this short-term price. They are orienting around this as an asset class that will emerge over the next 10 years. And it's not as if the bear market hasn't happened. They're aware that price is down. These people are very smart. It's that they sort of understand that that's part of the asset class. And the overwhelming consensus I get from them is just like, this is a slow but significant change, and we're moving in that direction. Maybe an idiosyncratic example of that is, Morgan Stanley approved Solana ETFs. Not because of FOMO, right? Quite the opposite. The market is down substantially. but rather because they see the direction of travel of tokenization and tokenized stocks as a decade-long trend would be my guess. I don't want to speak for them, but I think it's interesting that we're getting these sort of platform shifts in favor of adding crypto to portfolios, in favor of approving more crypto ETFs at a time where the market is down 50%. That really tells you something about the long-term nature of this orientation. So that's been maybe one of the biggest surprises from the people I've been speaking with, is that they're looking years ahead, not months ahead.
This brings us back to the question we started with. Should you buy Bitcoin now? Or wait for an even lower price? There is no guaranteed answer. Bitcoin can absolutely fall further, and anyone claiming otherwise is ignoring the defining characteristic of the asset. Hougan himself acknowledges that the market could still experience another decline. But waiting for the perfect entry creates a different risk, the possibility that the price never reaches the level you're waiting for. And if the long-term thesis eventually plays out, the difference between buying at one particular price and another may matter far less than simply having an allocation in the first place. That is also why DCA can make sense for investors who know they are vulnerable to their own emotions. It turns volatility from something you have to predict into something you can use. If Bitcoin falls, you accumulate more at lower prices. If it rises, you already own some. You don't have to know exactly where the bottom is. And for an asset as volatile as Bitcoin, avoiding a catastrophic behavioral mistake can be just as important as finding the perfect entry. But perhaps the most interesting part of Hougan's thesis isn't actually about Bitcoin's next move. It's about what is being built while everyone is waiting for that move. BlackRock is continuing to push deeper into digital assets and tokenization. Traditional financial institutions are exploring blockchain-based infrastructure. Standard Chartered sees tokenized assets potentially reaching trillions of dollars, and the financial industry has an enormous economic incentive to make markets faster, more global, and increasingly available around the clock. That means the quietness of the Bitcoin market may be hiding a much louder transformation underneath it. While retail investors are watching candles, institutions are watching infrastructure. Retail investors may be asking whether Bitcoin can fall another 10%. Institutions are asking what finance looks like in 2030. If you enjoyed this analysis, make sure to like the video, subscribe to the channel, share this video with someone who follows Bitcoin and crypto. Thanks for watching, and I'll see you in the next one.